So here's a question for you. In the current climate that we have at present, are you actually trading the signal or the noise around the signal? And the reason I ask that is really quite simple. At present, markets are surrounded by an enormous amount of noise. All you merely need to do is open up any section of the financial media, and it's all sorts of people prognosticating on what might happen, what has happened, what will happen, whatever. All of this is noise. And the unfortunate tendency I've seen of traders of late is that they're obsessed with trading the noise. They don't want to trade the signal. I can understand why this is, because trading the noise gives you the feeling or impression that you're busy, that you're involved, that you're actually doing something. But when you look at these things in the cold hard light of day, all you're really doing is burning cash. Let me give you an example. If you look at the price of crude oil, which has been a little bit of a dog's breakfast since the Russian invasion of Ukraine, if you go back and you're honest with yourself and you ask, where was the signal? Well, the signal was actually several weeks ago. The market's been in uptrend for quite some time. What you're seeing now is noise around part of the trend. In effect, for this part of the move, you're probably too late. So you're playing catch-up. What you're being consumed by is your fear of missing out. Now, I can understand why this occurs. The markets at present, or markets at all times, act almost like a permanent invocation to trade. There's a temptation to do something, to appear as if you're doing something, as if you're somehow involved in some way, shape or form. And markets are set up that way. We also have the occasional little incident of random reinforcement, where your trading of the noise actually makes you a small profit. So you think that you're actually onto something. If I can use an analogy that golfers will be familiar with, golfers often say that they play their best shots on the last hole. The previous 17 can be complete rubbish, but the ones you remember are those you played on the 18th hole. What does this do? It brings you back. You're crap for 95% of the day. But that tiny percentage you're not crap reinforces in you a belief in your own ability, and so you come back. Markets are the same. And in many ways, it is understandable, because at present we're full of these somewhat hackneyed statements of you buy when there are blood in the streets. The unfortunate thing about quotes like that is that the people who utter them don't understand the historical context, and they don't understand the entire quote. The entire quote from Rothschilds is, you buy when there is blood in the street, even if the blood is on your own hands. It puts the quote in a completely different context. And the quote itself, in terms of its historical context, comes from the small fortune Rothschilds made after the victory of the European allies over Napoleon at Waterloo. What Rothschilds had done is set up an intelligence network that gave him information of the victory of the European allies over Napoleon before anybody else. So the quote really should be, buy when you know something that other people don't know, or your form of market surveillance or intelligence is higher than other people. Not this somewhat hackneyed little statement we get that people trot out every now and again, along with stupid quotes by Sun Tzu and God knows who else. And so when you view these things, when you hear these things, it's necessary to understand the entire context. It's necessary to understand what environment that occurred in, so that you're not sucked in to these silly little statements. It's a little bit like, if you can extend the analogy a little bit further, it's a little bit like this constant nonsense you hear about buy the dip. Well, buy the dip works when you suffer from recency bias, when the only market you've ever experienced is one that's ever gone up. Now, that may or may not have changed, but the statement itself only has relevancy for a narrow segment of market history. It doesn't apply to all points of market history. If you, for example, enact that strategy in the bear market, well, you're really going to get your ass handed to you. And you will go out backwards, and you will go out backwards poor. So in terms of what is occurring at present, in terms of how markets are responding, markets always overreact. That is their nature, because it's the nature of human beings. So you see these wild swings. There is nothing that says you need to trade these wild swings. Yes, you will get the occasional peanut who pops up and goes, I made a fortune trading this wild swing. Well, that may or may not be true, and most of the things you read on social media are not true. But somebody also wins the lottery. So that raises the question of whether you want to base your financial future, your financial well-being, on the chance that you might win the lottery, as opposed to the notion of having built a long-term business that has long-term prospects, that is in the market forever. And at the time you leave the market is the time of your choosing. It's not that they carry you out because you've listened to some peanut either tell you to buy the dip or buy when there is blood in the streets.